Hey guys, this is Sudhir Pai, CPA from MyTaxFiler. Hope you all are doing well. I am here today to talk about different things that a person on W2 can deduct on the tax return form 1040. Now let me tell you, before I start talking about the deductible expense, let me tell you that we just have about 11 days, and in that we have 2 days on Saturdays, Sundays. So it's important that you think about your tax return now, get it filed or file an extension. Now when you file an extension, you get additional 6 months, and this is an extension to file, not an extension to pay. So make sure that you pay your estimated taxes or the amount of tax that you have to pay while filing the return before April 15th, or there will be penalties and interest. So one is extension to file, one is extension to pay. So just make sure that you are taking care of one of these two things, or file your return before April 15th. Now for businesses, we got done with the deadline, and the extended deadline now is September 15th, particularly the pass-through entities like LLCs and S corps and LLPs, LPs, and those structures. Now this also is a deadline for C corporations. April 15th, is also a deadline for C corporations. So you may want to make sure that you file your return or an extension by that deadline. So coming to the point today, coming to the subject that I'm about to talk about. So what are those things that one can deduct when they are on W2 or just salary income? Now, I get a lot of clients, who are young clients who have just come from India, or those who are earning, between 60 and 100K. They get a shock of their life, and they say that when they see that, they need to pay taxes when they are about to file their tax return. So, I just wanted to give out this particular, tip to their tax tip on how do you really look at, what all expenses can you deduct at a very high level. When you are in the US, there are a few things that you can deduct from your taxable income, or as an adjustment to the income. Now these are technical terms, but at a very high level for you as a layperson, you should be looking at taking a deduction for your mortgage interest, not the principal amount, but the mortgage interest for your primary property. You cannot deduct your apartment rent, but you can deduct your mortgage interest, which happens to be a significant part of the monthly payments that you make, because in the initial few years, most of the money is going towards your interest. The second one is, the interest that you pay on your second property is also deductible. Say you have a house in India or in your home country, the mortgage interest that you pay there is also tax deductible. The property taxes that you pay for your house, is also tax deductible. Now, when it comes to property taxes, there is a little bit of a twist in 2018 to 2026. The law now says that you can either deduct property taxes or the state income taxes. Say you are living in California and there is a state income tax. Now, both the amounts put together, you can deduct up to $10,000. You cannot deduct more than that. It's certainly not such a great news for people living in those states which tax income, such as California, New Jersey, New York, Ohio. But if they don't have state income tax, then you are good. You are getting a full deduction. Hopefully, the property tax is about $10,000. You get a deduction for that. Now, any donations that you pay to a non-profit organization in the US, you get a deduction for that as well, up to 60% of your income. Meaning, if you are at a $100,000 income range and you give $5,000 to a non-profit organization, say Salvation Army, or a temple of your choice, a church of your choice, a masjid of your choice, and they are registered in the US under the IRS 501c, then you get a deduction for that donation as well. You need a receipt to claim that deduction, but you can certainly deduct the money that you contribute to a non-profit. Medical expenses that you spend in the US are tax deductible if they are more than 7.5% of your income. So that's a significant number, 7.5%. But if you do have expenses that are incurred towards your deductible, or towards your co-pays, towards your expenses that are incurred during the particular year because of some other incident that might have happened, you can deduct that against your income as well. Now foreign taxes, if you have foreign taxes that you have paid on your rental property, now those are deductible as well. If you have a house in India and your parents are living there, now you have foreign taxes, then you can deduct that as well. But as a rental property, if you are receiving rent on that, either from external tenants or from your parents. Now the investment that you make in a 401k plan is about 18,500. You can do that through your employer. Even that reduces your income and you pay taxes only on the net. Or any money that you invest in IRA, an individual retirement account, up to $5,500, and if you're more than 60, then another $6,000 is tax deductible. Sales tax that you pay on any products that you purchase, that also is deductible in a way, because that is part of the tax payment, tax deduction that goes on the tax return. Any contribution to HSA, health saving account, towards which goes towards your medical or dental, or if there is an FSA program towards your dependent care, those things are also deductible. Now dependent tax, dependent credit, there is a credit for money that you spend for your dependents, such as you spend money on a nanny who takes care of your child or your dependent. Now there is a credit that you get. Now credit is not a deduction, but it's a reduction of taxes that you have to pay. So that's a $500 tax credit that you can get, dependent credit, dependent care credit. And then there is a child tax, child care credit as well, which is $2,000. This is again a tax credit, not a tax deduction. It reduces your tax 1:1, unlike a tax deduction, which is a deduction from the taxable income. Now tuition fees that you pay, for your kids for college, that can generate a tax credit of about $2,500. And if you don't have enough income, and if the credit is more, then you can get up to $1,000 back from the IRS. Now foreign tax credit paid in other countries on income that has risen in other countries, such as you have income in, say in India, you have dividends or interests or rental income or wages or any other capital gain. Now the tax that you pay in a foreign country is tax deductible in the US. And now standard deduction, if any of the deductions all put together, the list that I gave you doesn't come up to $12,000 if you're single, or $24,000 if you're joint, then you can directly deduct a fixed amount, which is called standard deduction, from your taxable income, from your AGI, and then that becomes taxable income, and you're good there. And then for Indian students who are in the US, they can also take a deduction for standard deduction. They can also invest money in an IRA. So those are the benefits. And for those who had a capital gain in the year 2018, now this is the fun part. If you had a capital gain in the year 2018, we can reduce that to zero on your 2018 tax return, because there is a concept called tax opportunity zone, which has been launched in the year 2017 December. And if you invest money in a tax opportunity zone, all your capital gain basically becomes zero, and you don't pay any taxes on your 2018 tax return. Now the money going in that fund will generate anywhere between 8 to 15% return, and all the return is tax free. So you may want to keep this in mind, or talk to your friends or relatives who have a tax liability because of a capital gain. Now those are tax free for 2018 if you invest in this tax opportunity fund. So that's all I have for today, friends. It's the busy season going on for us now. I'm taking time out of the busy time, busy schedule that I have, because a lot of clients want to get their returns filed before April 15th. If you are not one of them, then please think about it. Get your tax compliance done for 2018, and you can relax for the rest of the year and focus more on planning your 2019 income. That way your tax incidence on your 2019 income is going to be as less as possible. Keep in mind, you pay anywhere between 20 to 30 cents on a dollar of your income that you earn. So planning it is very important. Try to save as much as possible. That way you can enjoy that money or invest that money instead of paying Uncle Sam. Once again, guys, thanks a lot. This is Sudhir Pai signing off. I'll see you next week. Thank you.